Welcome to today's Explainer. We're skipping all the usual formalities and jumping right into a crazy historical mystery, one that might literally change how you view your entire investment portfolio forever. We are looking at a truly wild piece of financial history and connecting it straight to the modern markets you trade in today.
Okay, really think about this for a second. Imagine taking the deed to your house, the place you and your family live, and handing it over to a bank just to buy one single flower bulb. I mean, it sounds absolutely insane, right? Pure madness. But here's the thing. Not only did this actually happen, but the exact same human behaviors that caused it are still driving our financial markets right now. Section 1. The world's first financial bubble.
So let's take a quick trip back to the 17th century Netherlands. We're looking at what historians consider the world's very first recorded financial bubble, the infamous Dutch Tulip Mania. Now, innocently enough, people first started buying these exotic, incredibly vibrant tulip flowers just because they were beautiful. They quickly became this massive status symbol. If you were wealthy, you had tulips in your garden. It was actually a perfectly rational purchase for a luxury good. But then things took a turn. The psychology started to shift. The real danger kicked in when a totally new mindset took over. The mantra became, buy today, sell even more expensively tomorrow. It wasn't about the flower's beauty anymore, not at all. Instead, it just became a massive game of pure speculation. People stopped buying a flower to enjoy it. They were literally just buying the expectation that they'd get rich quick. And this spread like wildfire into an absolute frenzy. By the mid-1630s, actual physical flowers weren't even changing hands most of the time. People were trading paper contracts for future tulips. It got so out of hand that the price of a single, rare bulb skyrocketed to equal the cost of a luxury mansion. Ordinary people were literally mortgaging their homes just to get in on the action because they didn't want to miss out. But then, boom, February 1637 hits. People show up to a routine auction and, suddenly, there are zero buyers. The confidence just evaporated overnight, sparking a massive panic that crashed prices by over 90% in just a few days. Totally devastating.
Section 2. Comparing Nepse and the tulip.
Now, you might be wondering, why on earth are we talking about a 400-year-old flower market? Well, because it directly relates to today's Nepal Stock Exchange, or Nepse. But first, let's be fair and draw a sharp line between the two. Tulips had literally no intrinsic financial utility. They were just flowers driven 100% by hype. Nepse shares, on the other hand, represent actual ownership in real, breathing businesses. We're talking tangible assets, balance sheets, and real economic potential.
But, and this is the crucial part, it perfectly illustrates the real danger. While the assets themselves are completely different, the human beings buying and selling them, we haven't changed one bit in 400 years. The dangerous psychology driving the market remains exactly the same. We're talking greed, major FOMO, the fear of missing out, acting on wild social media rumors, and that dangerous herd mentality where everyone just buys because everyone else is buying.
See, when investors start pouring money into Nepse based purely on hype or some rumor, or just because a price jumped short term, completely ignoring the actual fundamental health of the companies, things get super dangerous. When the market sees these unnatural, abnormal price surges that have absolutely nothing to do with real business improvements, well, the mathematical risk of a financial bubble forming goes way, way up.
Section 3. Key lessons for investors. So how do we actually protect ourselves from this? The absolutely most crucial point you need to take away is this. A rising price alone is never, ever, a valid fundamental reason to invest your hard-earned money. If your only thesis for buying a stock is, well, it went up yesterday, so it's going to go up today, you aren't investing. You're speculating. You are doing the exact same thing that caused people to lose their family homes back in 1637.
Instead, you've got to rely on fundamental analysis. Before you put a single rupee into the market, look under the hood. Check the earnings per share. Look at the PE ratio. Do they actually make a profit? What is their business model? How's the cash flow? What do their legitimate future prospects look like? These fundamental metrics absolutely must take priority over whatever rumor is trending on social media right now.
At the end of the day, true, sustainable success in Nepse, or literally any market, is built on a rock-solid foundation of patience, strict emotional discipline, and long-term thinking. It's about having the sheer fortitude to just ignore the screaming crowd and stick to your own analytical framework.
Section 4. History's final message for today.
There's this great saying that history doesn't exactly repeat itself, but it definitely rhymes. The mechanics of the markets might evolve, sure, but the core drivers, They really don't. The asset itself is just a placeholder. Today, it might be Nepse stocks, tomorrow it's real estate, or maybe cryptocurrency, but our human emotions remain exactly the same. The mob mentality, that paralyzing fear of a market crash, the blinding greed during a massive rally. These things are hardwired right into our biology, and the only way to survive the market is to be fully aware of them.
Which brings us to our final and most important thought. I want you to ask yourself this every single time you're about to hit that buy button. Am I buying this asset based on its true underlying value? Or am I simply hoping someone else is going to come along and buy it for more tomorrow? The honest answer to that really uncomfortable question is honestly the only thing that separates a successful, intelligent investor from the victim of the next big financial bubble. Thanks so much for joining me for this explainer, and happy disciplined investing.